Welcome to Talk Tickers.
It's great to be back.
Usually we're here breaking down the latest earnings call from, a tech giant, or dissecting a retailer's quarterly guidance.
Exactly. We look at the public numbers.
The stuff that tickers across the bottom of the screen on CNBC. We live and die by the quarterly report, the guidance beat, the EPS miss.
We do.
But today, we are doing something a little different. We are going off the ticker.
We are venturing into, what did you call it? The dark matter of the financial universe?
Dark matter is a great way to put it, because today we are diving deep into the mechanics of private market valuations. I'm talking venture capital, private equity.
The assets that don't trade.
Exactly.
Yeah.
There is no NASDAQ Q opening bell for these companies. There's no flashing red or green number on a screen telling you what a Series B startup is worth at 10:00 a.m. on a Tuesday.
Which is the entire game for public stocks.
Right. So the fundamental question we're really trying to explore today is, if there isn't a price tag hanging on the shelf and there isn't a liquid market constantly debating the price, how? How do we know what anything is actually worth?
And that is the fundamental tension of private markets. It's this constant battle between what we call paper gains versus cash returns.
Paper versus cash.
And right now, in the financial world we're in today, that tension is tighter than a drum. I mean, it is the defining anxiety of this entire asset class.
It really is. And for anyone listening who thinks this is just, dry accounting, or this is just for the CFOs in the audience, you should buckle up.
Oh, yeah.
This is actually a story about psychology, about some pretty perverse incentives, and how a startup that's, say, running out of cash might still be valued at $100 million on the books.
It's the art versus the science of these numbers. And a lot of the time, the art wins.
We're going to get into that.
Yeah.
And we're going to talk about the very survival of these funds. Because in a post-ZRRP world...
Zero interest rate policy.
Right. After that era ended, valuation isn't just a math problem anymore. It's a matter of trust. Trust between the limited partners, the LPs who give the money, and the general partners, the GPs who invest it.
And that trust has been seriously frayed lately.
It has. We have a massive amount of ground to cover today. We're going to look at the academic history, and this goes all the way back to the Great Depression.
Which is fascinating stuff.
It is. Then we'll jump into modern industry reports about the current liquidity crisis, and then the actual mechanics, the formulas that determine if a fund is considered a success or a failure.
It's a complex landscape, but yeah, we're going to map it out for you.
Okay, so let's start with the basics, the yardsticks.
Yeah.
If I give a VC my money, I'm locking it away for, 10 years usually?
10, sometimes 12 or more.
This isn't like buying a share of Apple where I can sell it tomorrow if I don't like the new iPhone. I am stuck with this decision.
You are. You're illiquid.
So how do they tell me they're doing a good job in, say, year 3 or year 4 of the fund?
Well, they present you with a scorecard, a quarterly report. And on that scorecard, there are 3 really big acronyms you need to understand.
Acronyms, of course.
Of course, they are. Markup rate, MOIC, and IRR.
Okay, let's unpack these one by one.
Yeah.
Markup rate. This sounds like retail to me.
Yeah.
Like I'm buying jeans at wholesale and marking them up to sell at the mall.
It's a little bit different here, but the concept is similar. The markup rate is essentially a pulse check on the portfolio's momentum.
A pulse check.
Yeah, it measures the proportion of portfolio companies that have increased in valuation since the original investment was made.
Okay, let's make this concrete. If I'm a VC and I invested in 10 startups back in 2020, 3 of them have raised new rounds of funding at higher valuations.
Okay.
2 of them went completely bust.
Happens all the time.
And the other 5 are just... cruising along, treading water. My markup rate is 30%, 3 out of 10.
Exactly. The formula is simply the number of startups with markups divided by the total number of startups in the fund.
So what does that number actually tell me?
It's designed to answer the question, are we picking winners? It's a breadth metric. It tells you if the portfolio has life in it. If your markup rate is 0, that's a really bad sign. It means nothing is progressing.
So it's a leading indicator. But I have to ask, does a high markup rate actually mean I'm rich? If 90% of my companies are marked up, am I guaranteed a good return?
No. And that's the trap. A big one.
Why not?
It tells you that other people think your companies are valuable. It tells you another investor was willing to put money in at a higher price. But it doesn't tell you how much value has been created in total.
What do you mean?
You could have, say, 50 small markups that don't really move the needle. A company goes from a $10 million valuation to $12 million. Okay, great, it's a markup. But it's not the home run you need in venture.
Right, you need the billion-dollar exit.
You do. For the actual wealth creation, the magnitude, you have to look at MOIC, the multiple on invested capital.
Okay, this is the one. This is the one everyone quotes at dinner parties. Oh, I did a 3x on that deal. We're a 5x fund.
Right. It's the headline number. It's simply the total value, and that's a key point, total value divided by the total capital invested.
And break down total value for me.
Total value has two parts. Realized returns, which is actual cash back in the bank from a sale or IPO.
Real money.
Real money. And then the second part is the unrealized paper value. That's what we think the remaining stock in the other companies is worth.
So, mostly not real money yet.
Mostly on paper, yes, usually until the very, very end of a fund's life. So if you put in $50 million and the portfolio is now deemed to be worth $150 million, your MOIC is 3x. Simple as that. You tripled your money.
On paper.
We have to keep saying that. Yes, on paper.
And look, MOIC is great because it's simple. People get it. It captures the magnitude of the win. It tells you the multiplier effect of your skill as an investor.
But
it has a massive blind spot. It completely ignores time.
Explain that, because 3x sounds pretty good no matter what. Does it? I mean, if I turn $1 into $3 in 2 years, I am a genius. That is an incredible rate of compounding. You should give me all your money.
Okay, I'm in.
What if I turn $1 into $3 in 20 years? Well,
not so much.
Not so much. You probably would have been better off just putting that money in an S&P 500 index fund, or, depending on the environment, maybe even a high yield savings account.
So MOIC doesn't distinguish between those two scenarios. A 3x is a 3x, whether it took a decade or a century.
Exactly. So a 3x is not always a 3x. Context is everything. And that's where the third metric comes in. Gross IRR, or the internal rate of return.
IRR, the scariest of the three.
It can be, but the concept is simple. It accounts for the timing of cash flows. It's the annualized return. It basically tells you how hard your money is working for you every single year.
So it brings in the concept of the time value of money. $1 today is worth more than $1 tomorrow.
Precisely. It solves the time problem that MOIC ignores.
Okay, so this must be it then. This must be the gold standard. If I see a high IRR, I know the manager is efficient. They're not just getting returns, they're getting them fast.
You would think so. You'd absolutely think so. But IRR introduces its own quirks. It is incredibly sensitive to early wins. In fact, it can be mathematically manipulated if you aren't careful, or if you're a bit cynical.
How so? Manipulated.
Let's run a scenario. Let's say a fund calls capital from you, they ask you for the money, and they invest it. 3 months later, one of their small companies gets bought out for a quick 2x profit.
Okay, not a huge multiple, just double the money.
Just double the money. But because that cash came back so fast, in just 90 days, the IRR calculation goes a little haywire. It extrapolates that return as if it could be sustained forever.
Like it assumes you're going to double your money every 90 days for the next 10 years.
Exactly, which is impossible. You might see an IRR on the quarterly statement of 400% or 500% in the early years of a fund.
But that's not real life. You can't keep doing that. You'd own the planet.
Yeah. You would own several planets. It inevitably always drifts down. So early in a fund's life, IRR is basically a vanity metric. It looks fantastic on a marketing deck when you're raising your next fund, but it doesn't mean the fund will actually finish strong.
Wow. So it sounds like all of these metrics are flawed in isolation.
They are.
Markup implies momentum, but it ignores the magnitude of the wins.
Yep.
MOIC implies magnitude, but it totally ignores time.
Correct.
And IRR implies speed, but it can be distorted by a little bit of early luck.
Precisely. That is why you have to synthesize them. You need to look at all three together. Think of it like a car dashboard.
Okay, I like us.
The markup rate is your RPM gauge. Is the engine revving? Are things happening? Are you getting upshifts?
Makes sense.
MOIC is the odometer. How far have we actually gone? How much distance have we covered on our journey?
And IRR.
IRR is the speedometer. How fast are we moving right now?
So if you only look at one of those, you're going to crash the car.
Or you'll run out of gas while thinking you're speeding along. You absolutely need the holistic view.
Okay, so those are the scores. That's how we judge the game. But now let's get into the dark arts.
Yes.
How do we get the numbers that go into the score? If a company's public, it's easy. I look at the ticker. The market decides. Millions of buyers and sellers agree on a price. But if a company is a startup that hasn't raised money in 2 years, who decides what it's worth?
And this brings us to the valuation conundrum, price versus value, and specifically the big debate between the 409A valuation and the VC price.
This is a huge point of confusion. We see this all the time. A startup says we are worth $1 billion in the press.
The unicorn valuation.
Right. But then their employees exercise options at a price that implies the company's only worth, say, $200 million. Someone is lying, or at least someone is using a different calculator.
They are definitely using a different calculator. Let's start with the 409A.
Okay, 409A.
A 409A valuation is named after a section of the IRS code. It's a formal appraisal done by a third-party firm, and its job is to determine the fair market value of the common stock.
The common stock. So the stock employees get.
Exactly. This is what you use to set the strike price for employee stock options.
And the incentive there is to keep it low. Right? If I'm a founder and I'm hiring a brilliantly talented engineer, I want to give her options with a really low strike price.
Of course.
If the strike price is $1 and the stock is worth $10 when we sell, she's happy. She made $9 a share. If the strike price is $10, she has no paper profit at all.
Exactly. You want it low. You want the spread to be as high as possible to attract and retain talent. And the appraisers can justify that low price because common stock is, frankly, worse stock.
Worse how?
It has fewer rights. It's at the very bottom of the stack if things go wrong. But the VC price, the number you see in the TechCrunch headlines, that is based on preferred stock.
Preferred stock. So that's the VIP ticket.
That's the VIP ticket. It comes with all sorts of special terms. Liquidation preferences, control rights, anti-dilution protections, board seats. A VC isn't just buying a share of the company. They're buying a share with insurance attached. They're buying influence.
Right. I remember hearing a saying in the industry, something like, fair is irrelevant, only market clearing numbers matter.
That is the VC mindset in a nutshell. They are looking for the market clearing price. What is another sophisticated investor willing to pay for this VIP ticket? They don't really care what the tax man thinks the common stock is worth for option purposes. They care what Sequoia or Andreessen Horowitz thinks the preferred stock is worth.
And this all ties into the power law, doesn't it?
It absolutely does. The power law basically dictates the entire strategy. It says that in a venture portfolio, 1 or 2 companies will return the entire fund and the rest. The rest will probably go to zero or return very little.
So you expect to lose most of the time.
Yes. VCs expect to lose money on, say, 60 to 80% of their bets. They absolutely need that 20% to be massive outliers, home runs. And because of this high failure rate, they structure deals with downside protection.
And that means liquidation preferences.
That's the main tool. And this is crucial to understanding why valuations can look so weird on paper.
Okay, can we dig into liquidation preferences for a second? I feel like this is a term people hear, but they don't fully grasp the impact of. Let's run a scenario.
Sure. Let's imagine you're a VC and you invest $10 million in a company for 10% ownership.
Okay, so that implies the company is valued at $100 million post-money.
Simple math. Now, let's say things go wrong. The market crashes, the product doesn't get traction. The company has to sell tomorrow for just $10 million.
Wow. So the company sold for a tenth of what it was supposedly valued at. That's a 90% wipeout, a disaster.
For the founder, yes. For the employees, absolutely. But if you, the VC, have a standard 1x liquidation preference, it means you get your money back before anyone else gets a single cent.
So the company sells for $10 million. I, the VC, take that entire $10 million.
You do. You are made whole. You have lost nothing on your investment.
And the common shareholders, the employees who worked late nights for 4 years, the founders who started it all, what do they get?
They get zero. Wiped out completely.
Wow.
And this creates a huge distortion in valuation reporting because even if a company is struggling, if the VC has that liquidation preference, they can go to their LPs and say, well, my slice of the pie is still worth the original investment because I get paid first.
Even if the enterprise value of the whole company dropped by 50%, my $10 million is safe.
Exactly. It shields them from reporting bad news. It acts as a buffer. It creates what we call the J-curve.
The J-curve.
Yeah, where losses come early in a fund's life and the big returns come late. Liquidation preferences help flatten out those early losses on paper. It creates a floor for their valuation.
But is that honest?
Well, some critics argue it's an irrational response to loss aversion. You're basically hiding bad performance to keep the LPs happy and not spook them. It allows a zombie company, one that's not growing but not dead, to look like a stable asset on the books for years.
Which brings us perfectly to the art of the interim mark.
Ah, yes.
So we have this scenario. A company raised money at a $100 million valuation. It's been, say, 18 months. They haven't raised a new round. They have 4 months of cash left in the bank. They are struggling. The question is, what is that company worth today?
This is where the science completely ends and the art, or maybe the argument, begins. Because there is no market price. There is just a board meeting and a spreadsheet and a lot of motivated reasoning.
We see a few different ways managers handle this. Option A, they just hold it at cost.
The head in the sand approach.
It was worth $100 million then, so it's worth $100 million now until someone proves otherwise.
Which is, let's be frank, incredibly optimistic given they have 4 months of runway. That is bordering on negligence. If you are telling your retirees and pension funds that this asset is solid when it's about to miss payroll, that is a huge problem, but it absolutely happens.
Okay, so that's one option. Option B, mark it down to comparable market multiples.
The more honest approach.
You look at the public markets. If public software stocks crashed 50% since 2021, you say, okay, we have to be realistic, and you cut this internal valuation by 50%.
That is the mark-to-market approach. It's more intellectually honest. It acknowledges that the world has changed, but it is painful. It crushes the fund's interim IRR. It makes the manager look bad, especially if they're trying to raise their next fund.
Right. And then there's option C, the VC.
Yeah.
They bridge the company.
Ah, the bridge.
They put in a little more money, maybe just $1 million at the old valuation.
Just to hold the mark.
What does that mean?
It's known as kicking the can down the road. You throw a little bit of good money after bad to avoid admitting a loss on paper. You can then go to your auditor and say, look, we just invested at this price, so it must be the fair price.
And the auditor's role here is huge.
It is. Their job is to look at that struggling company and ask, is this a going concern? Can it continue operating? If they only have 4 months of cash and no new investors lined up, the auditor might come in and force them to market all the way to zero.
So the valuation for the exact same company with the exact same facts can literally range from $0 to $100 million.
Yes.
Depending on how good a story the VC tells the auditor, or if they're willing to write a small check to bridge the gap.
Exactly. The range of outcomes for the same set of facts is staggering. And this subjectivity, this art, isn't just a quirk of the industry. It is deeply rooted in the history of accounting rules. This battle over how to price things that don't trade has been going on for a century.
Let's go there. Because this part of the research surprised me. This whole idea of fair value, of marking things to what they were today, was actually illegal at one point.
It was. If we go all the way back to the 1930s, to the Great Depression, Franklin Delano Roosevelt, FDR, he abolished fair value accounting.
He banned it. Why would he do that?
Well, it was blamed for contributing to the Great Depression. The argument was that marking assets to market prices during a crash forces banks to write down their assets.
Because if the market is panicking, the price is artificially low.
Exactly. The price is low, so the bank's balance sheet looks terrible. They look insolvent.
And if the bank looks insolvent, regulators get nervous and force them to sell more assets to raise cash.
Which drives prices down even further. It's a feedback loop, a death spiral. So FDR stepped in and said, enough, we are stopping this madness. And for decades after that, we used historical cost.
So you just value things at what you paid for them.
Yep. You bought a building for $10. It's worth $10 on the books until you sell it, even if the market crashes or skyrockets 30 years later. Simple. A little boring, but stable.
Very stable, but also very inaccurate. Imagine owning a skyscraper in Manhattan that you bought in 1940. On the books, it's worth pennies. In reality, it's worth billions of dollars. The balance sheet becomes a work of fiction.
So eventually the pendulum had to swing back.
It had to. In 1975, the FASB, the Financial Accounting Standards Board, issued something called FAS 12. And this allowed reporting unrealized gains and losses for the first time on certain securities. It was the first crack in the dam.
And then we get to the big one, the modern standard, FAS 157, which is now known as ASC 820.
Introduced in 2006, right before the big storm. This is the rule book we all live by today. It defined fair value as the exit price.
The exit price.
The price you would get if you sold the asset today. Not what you paid for it, not what you hope it's worth someday, what you would get if you had to sell it right now. And, crucially, it introduced the hierarchy of inputs, the famous pyramid.
This pyramid is so key to understanding how VC and private equity works. Can you walk us through the 3 levels, level 1, 2, and 3? Absolutely. So level 1 is the base of the pyramid, the most reliable, it's observable, quoted prices in active markets. Think Apple stock. You know exactly what it's worth to the penny at any given second. There is no debate.
Easy enough. Level 2.
Level 2 is for assets that don't trade every day, but you have observable inputs for similar assets. You can look at interest rates, yield curves, prices of comparable bonds, things like that. It requires some math, but it's based on real external data points.
So it's still pretty objective. And then we get to level 3.
And then we get to the top of the pyramid. Level 3, unobservable inputs. This is where private equity and venture capital live. The valuation is based on the entity's own assumptions.
Its own assumption.
Yes. There is no ticker. There is no comparable asset trading every day. You're flying by instruments.
It sounds a bit like trust me bro accounting.
To an extent, yes. I mean, it is model-based. You build a discounted cash flow model. You look at the comparable public companies, but you, the manager, choose the inputs. You choose the growth rate assumption. You choose the discount rate.
And that's where the subjectivity comes in.
That's where all the art and argument happens. And this is where the controversy lies. Because when the financial crisis of 2008 hit, that debate from the 1930s came roaring back with a vengeance.
Did fair value accounting cause the 2008 crash? That was the accusation, right?
That was the accusation, absolutely. Critics called it the death spiral argument all over again. Banks held these incredibly illiquid assets, mortgage-backed securities, CDOs.
And the market for them just froze.
Completely froze. No one was buying. So the market price was effectively zero, or whatever a fire sale price was.
So the accounting rules forced them to write them down to basically nothing, which blew up their capital ratios and made them look insolvent.
Exactly. There's a famous example. Merrill Lynch sold a CDO portfolio that had cost them $30.6 billion. They sold it for just $6.3 billion.
Wow.
That's 22 cents on the dollar. That single write-down destroyed their balance sheet. They had to raise capital, which panicked the market, which hurt their stock, and down the drain we go. It's the death spiral in action.
But there's a counter-argument, right? That the accounting wasn't the cause, it just revealed the truth that was already there.
Yes, and it's a very strong counter-argument. The SEC and many investor groups argued that fair value didn't cause the bad loans, it just turned the lights on.
You can't blame the thermometer for the fever.
That's the perfect analogy. AIG had to take massive write-downs that led to their bailout, but the issue wasn't the math used to count the assets. The issue was the incredibly risky derivatives they held in the first place. If we had used historical costs, those banks would have looked solvent on paper while actually being completely rotten to the core.
There was also this specific rule that got mentioned, FAS 159, the fair value option. This sounds like a loophole that got exploited during all the chaos.
It was intended to give companies more flexibility, but yeah, it got messy. It allowed companies to voluntarily choose to use fair value for certain assets. But here was the trick.
Uh-oh.
When you first adopt the rule, you can take any cumulative losses you have on those assets and dump them directly into opening retained earnings.
Retained earnings. That's on the balance sheet, right? It bypasses the income statement?
It completely bypasses the income statement, so it effectively hides the loss from the current quarter's profit and loss report. It goes straight to the equity section of the balance sheet where, frankly, fewer people look.
So you could make your quarterly earnings look way better than they actually were.
Yes. We saw banks play games with this. Seacoast National Bank is a famous example. They adopted the rule early, dumped a bunch of losses into retained earnings to make their income look better, but then they realized it was confusing everyone so much that they actually rescinded the adoption later on.
They took it back. Just kidding, we aren't doing that anymore.
It just shows you how chaotic the implementation was. It was a time of radical experimentation in accounting right as the entire financial world was melting down.
So, okay. We have this long history of accounting trying to find the truth in prices. We have this tension between mark-to-market volatility and historical cost stability. Now, let's fast forward to the present day, the post-2022 world.
The new reality.
The ZRRP era is over. Interest rates went up, the market corrected, the frothy days of 2021 are long gone.
And with them, the metric of choice has completely changed. We have shifted from a world obsessed with TVPI total value, that paper wealth, to a world that only cares about DPI.
Distributions to paid-in capital. Cash is king again.
Cash is the only thing. During 2020 and 2021, funds had these massive TVPIs because they were marking up their portfolio companies based on these crazy funding rounds.
Right. Oh, Tiger Global just led around at 100x revenue. Great, let's mark up our whole portfolio by 30%.
That was literally the thinking. But as those public market multiples collapsed and those paper valuations evaporated, LPs woke up and realized that paper gains don't pay the bills. You can't buy groceries with a markup. You can't pay pensioners with the MOIC of 3x if it's all unrealized.
There is a brutal statistic in the research here from Carta that really highlights just how dry the desert has become. They analyzed 1,800 funds.
It's a sobering number, yes. For vintage 2019 funds, so these are funds that are 5 years old now, they should be halfway through their life cycle. Over 60% of them have returned nothing to their investors.
60%.
Zero distribution.
5 years. You give someone your money, and half a decade later, you have not seen a single penny back.
Not a penny. And for the 2021 vintage funds, the ones started at the peak of the bubble, only 9% had returned any cash at all within 3 years.
How does that compare to normal times?
Well, compare that to the 2017 funds. For that vintage, about 25% had distributed cash by the 3-year mark. So we've seen a massive slowdown.
Why?
The exit liquidity has just dried up. The IPO window slammed shut. M&A slowed down because of antitrust fears and these huge valuation disconnects between buyers and sellers.
So if you are a fund manager and you can't sell your companies via IPO or M&A because the market is cold, how do you get cash to your increasingly angry investors?
Exactly, because if you don't give them cash, they will not invest in your next fund.
That's the bottom line.
That's it. So you have to manufacture liquidity. We're seeing managers get very creative. One strategy is what they call structured exits.
What does a structured exit look like?
It means building in things like redemption rights or mandatory dividends into your investment deals. Or we're seeing a lot of revenue share bridges.
Revenue share bridges.
Yeah. A fund might lend more money to a portfolio company, but instead of just getting more equity, they get a share of the company's monthly revenue. It basically turns a growth asset into a yield-generating asset.
So they're squeezing cash out of the startup before the actual big exit. I can't sell your stock, so just give me a piece of your sales right now.
That's exactly it. They are also recycling capital. So if they do get a small win, a small exit, instead of distributing that cash to LPs,
they reinvest it.
They might reinvest into one of their best performing companies, but there is a huge trade-off there.
What's the trade-off?
Well, reinvesting could boost the fund's ultimate multiple, the MOIC, if that company turns into a huge winner. But it hurts that all-important DPI number in the short term. It delays the cash payment to the LP even further.
It's a real dilemma. And the sources mention that LPs are now tracking new KPIs like time to cash.
TTC. The velocity of returns. LPs are asking, how fast can you get my money back to me? Because $1 today is worth a lot more than a maybe dollar in 2030.
Especially in a high interest rate environment.
Especially now. The opportunity cost of capital is real again. If I can get 5% risk-free in a treasury bond, your illiquid, risky VC fund better pay me back fast, and it better be a high return.
And if the GPs, the fund managers, can't generate cash in the companies, the LPs are sometimes forced to find their own liquidity. They have to sell their stakes in the funds themselves.
Which brings us to the secondary market.
Yes, this is where LPs sell their interest in a VC fund to another investor.
It's a fascinating and crucial part of the ecosystem, and it all starts with something called the denominator effect.
I love this term. It sounds like a physics problem. Can you explain it?
It's actually pretty simple. Imagine you are a large pension fund. You have a strict asset allocation model. Your rules say you want 10% of your money in private equity and 90% in public stocks and bonds.
Okay, a 90-10 split.
Now, in 2022, the public stock market crashed. The value of your stocks went down significantly.
So my $90 million in stocks suddenly became, say, $70 million.
Right. But your private equity holdings, because of those sticky valuations we talked about, the managers refusing to mark them down stayed on the books at $10 million.
Okay.
So let's look at your pie chart now. You have $70 million in public assets and $10 million in private assets. Your total portfolio is now $80 million. What percentage is private?
$10 out of $80 is 12.5%.
Exactly. You are suddenly overweight in private equity, not because you bought more, but because everything else shrank. The denominator got smaller.
And my governance rules say I can really be at 10%.
So to rebalance your portfolio and stay within your rules, you have to sell some of the private equity. You become a forced seller.
And the sharks in the water, the secondary buyers, they know this.
Oh, they do. And because a lot of LPs were in the same boat, all having to sell at the same time, and liquidity was low, prices dropped. We saw massive discounts to NAV, or net asset value.
How big were the discounts we're talking about?
For buyout funds, funds that own more mature companies with real cash flow stakes, were trading at about 90% of NAV. So a 10% haircut. Not too bad.
Okay.
But for venture capital funds, they were trading at an average of 69% of NAV.
Wow. That is a 31% discount.
A huge discount. It means if the VC manager's statement says your stake is worth $1 million, the secondary market is saying, yeah, I'll give you $690,000 for it.
And what does that discount really represent?
That discount reflects the intrinsic value risk. The market is effectively saying, we don't believe your marks. We think you are overvaluing these underlying assets by 30%. So we are pricing that risk in.
There was also this weird dynamic with supply and demand. There was plenty of dry powder money sitting on the sidelines waiting to buy, but deals weren't happening.
The bid-ask spread was just too wide. The sellers were emotionally anchored to 2021 prices. They were thinking, my stake is worth $1 million.
And the buyers wanted 2023 discounts.
The buyers were coming in saying, I'll give you $600K. It created a complete standoff. Transaction volume plummeted because neither side wanted to blink first.
But we also see a lot of variance in who is marking down and by how much. The common fund data on this was really interesting. They looked at how different managers valued the exact same companies.
This is the smoking gun of valuation subjectivity. It's fascinating. You would think that a share of the same company, say a share of Stripe or SpaceX, is worth the same amount no matter who owns it.
Should be, right?
It should be. But Common Fund found that on average, managers mark these companies at a 23% discount to whatever the last funding round price was. However, the range was wild.
Some were at a 40% discount, some were basically at 0%.
And you can see a real pattern. Newer managers, those on their funds 1 or 3 or 3, they tended to mark their portfolios closer to the last round high. They didn't discount as aggressively.
Why would that be?
Incentives. It's always incentives. If you are a new manager, you need to show traction and momentum to raise your next fund, Fund 4. You cannot afford to show a 40% drop in your portfolio value. You need to tell a growth story.
And the established managers.
An established firm. A Sequoia or a Benchmark. They have a long reputation. They have decades of trust built up with their LPs. They can afford to take the hit now, look conservative, and say, we are being prudent with your capital. It actually builds trust for them. For the new guy, it just looks like failure.
The report also noted a geographic difference.
It did. China-based managers applied smaller discounts on average, around 17%, compared to managers in the US or Europe. That could suggest a difference in maybe local market optimism, different accounting practices, or perhaps just the nature of the pressure on those specific LPs.
So with all this chaos, these huge discounts, subjective marks, the lack of cash, the LPs are fighting back. They're demanding better rules. The governance of valuation is changing.
It is. The days of the black box are ending.
What did the old school LPA, the limited partnership agreement, look like?
The old school agreement was basically, we, the GP, will tell you the value of the portfolio once a year. We'll use our own method, whatever we think is best, and our number is binding. Don't ask questions.
See you next Christmas. Just trust the process.
That's it. And that doesn't fly anymore. The new best practices require quarterly valuations delivered within 60 days of the quarter end. Can't wait a year to find out what's going on.
And you have to reference specific standards like IPEV?
Yes, IPEV.
What is that?
The International Private Equity and Venture Capital Valuation Guidelines. It's basically the global rulebook. It pushes for consistency and transparency. It says, if you use a multiple to value a company, you have to explain why you chose that multiple. If you use a DCF model, you have to show your assumptions.
So no more pulling numbers out of thin air.
Well, less of it. And the LPs aren't just reading the reports anymore. They are actively checking the homework.
Through things like the LPACs.
Exactly. We're seeing the rise of the LP Advisory Committee. This is usually a group of the biggest investors in the fund. They now review the fund's entire valuation policy. And in some cases, they review specific large marks.
So they can challenge the manager.
They can and they do. If the GP wants to hold a valuation flat while the public market comparables have crashed, the LPAC can now ask, why? Show me your work. Why is your SaaS company still worth 20x revenue when Salesforce is trading at 6x?
The sources mention some of these more robust methodologies like the Equitum hybrid. What is that?
It's an attempt to triangulate value. So you don't just rely on one method because we know they're all flawed. You blend multiple approaches. You might use a qualitative scorecard. How good is the team? What's the market size? You combine that with a discounted cash flow model and also the classic VC method of working backward from a hypothetical exit price.
So using multiple lenses to find a number that isn't just a wild guess.
It's about reducing the variance and taking out some of the bias. The whole goal is to move the conversation from trust us to here's our methodology, let's discuss it.
Because transparency breeds trust.
And in a liquidity crisis, trust is the only currency that actually matters. If an LP doesn't trust your marks, they will not give you money for the next fund. And if you can't raise the next fund, you are out of business. It's that simple.
So let's try and wrap this all up. We've gone on a huge journey today. We went from the high-level acronyms MOIC, IRR, down into the really dirty mechanics of 409A versus the VC price.
Yeah.
We looked at the history all the way back to FDR banning fair value accounting and then brought it forward to the modern pressure for DPI, for cash.
It's a journey from pure accounting to really psychology. We have these standards, ASC 820, the IPEV guidelines, all trying to impose order, trying to turn this art form into a science.
But can you?
Well, ultimately, because these are level 3 assets, because there is no ticker tape, human judgment and human bias are just baked into the cake. You cannot regulate away optimism or fear.
It's a black box, but now there's some rules scrawled on the side of it.
That's a great way to put it. And that black box is now being pried open by LPs who are desperate for cash. The pressure is finally forcing the truth to the surface.
Okay, so here's a final thought for you to chew on as we close out. We see this immense push for quarterly marks, for mark-to-market discipline, for basically treating private assets more and more like public ones. We want them to update constantly with the market.
Yes, there's this convergence of expectations.
So here's the question. If we force private markets to move in lockstep with public market volatility, are we destroying the one thing that made them so special in the first place? I mean, the whole point of private equity was that you didn't have to care what the stock market did on a Tuesday.
Yeah.
You could ignore the short-term noise and build for the long term.
That is the multi-trillion-dollar question, isn't it? If a founder now has to worry about their valuation every 90 days because their VC is getting grilled by an LPAC, do they stop taking big risks? Do they stop building moonshots and start just optimizing for short-term revenue metrics to keep the spreadsheet looking good?
Are we maturing the asset class, or are we accidentally making it just another flavor of the stock market with all the short-term pressures that come with it?
I don't think anyone knows the answer yet, but it's the defining question for the next decade of this industry.
Something to mull over. Thanks for listening to Talk Tickers. We'll see you on the next deep dive.